Thank you for standing by, and welcome to the Vimy Resources conference call to present the Mulga Rock Project DFS Refresh. As you will be aware, Vimy released the results of the DFS Refresh to the market on Wednesday this week. All participants are in a listen-only mode. Mike Young, Vimy's Managing Director and CEO, and Marcel Hilmer, CFO, will present the results of the DFS Refresh, which were detailed in Wednesday's announcement. This will be followed by a question and answer session, where Mike and Marcel will respond to a selection of the questions submitted prior to the call. I would now like to hand the conference over to Mike and Marcel. Please go ahead.
Thanks very much. Good morning, everyone, and thank you very much for dialing in this morning. Look, we're pretty excited about the outcomes of the DFS Refresh. People that have been following us know that we released DFS 2 years ago into what is a flat market, but some of them, as we know, also some of the market is improving. And as we went through, we decided we should have another deep dive into the DFS. Some of the highlights, of course, the NPV has increased by 14%. And I must add that's on a lower price in the model, so we've used a $55 weighted average contract price for that, whereas in the original DFS it was 60. And Marcel will talk a little bit about that when we talk about the sensitivities. Really importantly, the capital cost has come down. We've had a 20% reduction there, and again, we'll get into the details of all this as we move through it. But that's probably the most significant activity that we took was to look at the capital costs. And of course, the operating cost came down as a result as well, with the C1 cost being, your mining costs on site, not including royalties of $23 over the first 5 years, and a C1 cost of 26, and then all-in sustaining costs of 28 over the first 5 years. Now, the reason that we talk about this 5-year window is that, and the details of this are in the actual DFS from 2 years ago. We decided that we would mine higher grade pits in the early parts of the operation to generate early cash flow, brings a value forward. But some of those pits will also be used for tailings disposal facilities as well, so it kind of has a double effect. So that's why we talk about the first 5 years, and that's generally a contracting cycle is about the same. So these numbers are very impressive for us. We've had decreases across the board. A lot of work went into the DFS, as Marcel will highlight. But the important thing is that this really does move us along the cost curve. It moves us down the cost curve, and the operation Mulga Rock is now competitive with the higher cost operations in Kazakhstan. So that's an important link for people to make. I mean, Kazakhstan is often, people conflate it with cheap production. It is cheap, but for us to be competitive in the middle of the cost curve is really important, and it's something that will certainly get noticed by utilities and also people that may want to do strategic partnerships with us, and we'll talk a bit more about that. I'd just like to introduce Marcel. He is sitting there in the background. And hello, Marcel.
Good morning, Mike, and good morning all those that have joined the call.
Somebody online referred to Marcel as my domestique, so everyone knows I like cycling, and Marcel's more than a domestique. He is absolutely, we're joined at the hip, and I absolutely couldn't have done this without him. Just give us a history of the DFS Refresh and why we did it. So in 2018, we completed the DFS on the project. It demonstrated that it had very good economics and low technical risk, and I'll just talk a bit about that. So during the DFS, we did 2 test pits. They were about 50 meters deep. We excavated 100 tons of ore from those test pits. Those pits were done ostensibly to assess the diggability of the overburden. It's a flat-lying ore body. It's got overburden ranging from 19 to 63 meters. So we've got to move some dirt to get to the ore. And the difference between free digging and drill and blast is in an operating cost sense, and also a risk sense, is very high. So we wanted to ensure that it was free digging. We suspected it was from a test pit that had been dug many years previously, and also from our drilling. So that was very successful. We showed that the deposit was free digging, and then we took that 100 tons of ore and we put that through what is referred to as a full-size pilot plant. So by that I mean we didn't build a a full-size plant, but all of the things that require assessment of hydraulic head, like your leach tanks, your thickening tanks, they were all built at scale. And so that pilot plant was really important in de-risking the metallurgy of the project, and we showed that the metallurgy is very low risk, and it's actually quite simple. It's just an acid leach and then what we call resin and pulp, and then we just dilute the uranium and produce a yellow K concentrate that we then ship away. So that was all very successful. But what we did was in 2019, we did an external review of the DFS, and what that found was the mining strategy, the mining schedule, the flow sheet that I've just talked about. All that work was carried out to a very high degree. In fact, the guys who did the study, very experienced, white-haired gentlemen, and they said that was one of the best DFSs they'd seen in their careers. So we're very happy about that, and that's a tribute to Tony Chamberlain and his team. Tony, of course, is still on our board. But what they did find was that we probably had some high manning levels, and there was some significant reductions that could be done by looking at our mining strategy. So the DFS contemplated an owner-operate model, and that certainly reduced the operating costs, but it had a $93 million capital cost up front. And so we spent a lot of time looking at that, and again, Marcel will get into that in a bit more detail. But importantly, what we decided was, with the refresh, that we would look at some of the recommendations that were made in the 2019 study, and but no material changes were made to the mining metallurgy process, material movements, and uranium output. So you can see that on page 2 of the report, which is the highlight of the key parameters. So again, just looking at that, you can see the capital coming down. What we've done there is we've put 2 columns, so you can see the January 18 versus the DFS refresh, and you can see that we've had reductions across the board. There were some areas where costs did go up a bit, but by and large, most of the costs came down, and certainly the operating costs came down. And I'll let Marcel get into a bit more detail there. Speaking of which, I might throw to Marcel now, and he can take you through some of the detail and some of the areas where we did savings. And then after Marcel's done, throw it back to me, and we'll have a little bit of chat about the market and our plans going forward, and then we'll get into some of the questions. Thanks, Marcel.
Thanks, Mike. Well, on page 3, there's a couple of waterfall charts, and the first one provides you with the movement from what was 493 million Australian dollars down to 393.1 million. Mike touched on the change to the mining, where we went from contract mining to a hybrid mining with a very well-regarded mining company in Perth and throughout Australia providing those services. We were able to achieve a $63 million reduction, which is the bulk of the reduced CapEx. But there were other areas where we achieved reductions, noting that the process plant did go up because of cost increases. In terms of indirects, owners' costs and contingency, well, we were able to reduce some of those indirects, particularly in the areas of mobile equipment, bulk fuel storage and communications. The contingencies generally come down because of a reduced capital cost, because they're normally on a percentage, in our case 8% for design growth and owner's contingency. So we were able to achieve, without any changes to the flow sheet or the infrastructure, a reasonable reduction of 20% of the total cost for capital. Some of that flowed through into the operating cost, which is figure 2 on the 3rd page, and you'll see there that we've been able to reduce our all-in sustaining costs from $33.99 down to $31.22. I don't propose on this call to go through each of them, but to say that on an overall basis, a lot of those costs were through labour savings, both in terms of numbers and also contract rates. The impact of a reduced foreign exchange currency rate with the US from 70 to 65 cents had an impact, and other efficiencies. Of course, some of those, like royalties and depreciation, are expected as a result of using a reduced commodity price. and a lower capex respectively. So that gives you a sense of the magnitude and the reasons why we've been able to reduce both capex and opex in this refresh. Back to you, Mike.
Thanks, Marcel. Sorry, I muted myself there for a second. Just driving into a bit more detail on page 4, there is a breakdown of what we call cost summary to the cumulative all-in sustaining cost. And again, I am going to hammer on about how low these costs really are. So the waterfall chart that Marcel was referring to was a life of mine all-in sustaining cost, and you can see at 3122. Very, very competitive. So what I'd like you to do is, if you're following along with the announcement, is have a look at page 10. So page 10 is the all-in sustaining cost curve for uranium. Now this is our curve done by Julian Tapp, who some of you will know. Julian is what we call our chief nuclear officer, which basically means he does everything that Marcel and I don't. But he has been working on the uranium market for the last 7 years. He's chair of the supply working group for the World Nuclear Association. So very, very deep and long inside knowledge on the industry. So this is an updated curve, hot off the press. What it is our estimated all-in sustaining cost for uranium producers. It does vary from other people's curves, partly because we try to incorporate royalties and sustaining capital in those numbers. And you can see he's even included secondary supplies. So, full disclosure here. Cigar Lake we've got in there because they did produce during 2020. They have announced they're coming back in. You can see the slew of Kazakh operations, and you can see where Vimi's year 1 to 5 all-in sustaining cost sits. And look, even our life of mine all-in sustaining costs just slightly higher than 4 Mile. The important thing there is it now sits in the middle of the cost curve, and even at $31, we're in the early part of the third quartile. So when you're thinking about, how are we going to get contracts? Well, basically, this is the cost of producing uranium today, and then you can see that there's a gigantic gap between what's actually being produced in 2020 and what's being burned in 2020. And so that gap is, well, we could refer to it as the investor's opportunity gap. And obviously some of the production in there, including the McArthur River, will come back on, fill that gap, but there's still a systemic shortage going forward. And those requirements, the lines on there, those are from the World Nuclear Association Fuel Report. So the thing is, even in a static market, so even if there were no growth, we're middle of the cost curve competitive. And when the utilities start returning to the market, and they will, they'll basically be putting out RFPs, or we'll be doing private discussions as we are. And then I use this phrase, walking up the cost curve. So basically what happens is the early RFPs and discussions will sweep up some of the cheaper material, and then they'll move up the cost curve. And, us being in the middle of the cost curve, you'd assume that that's going to happen relatively early in the contracting cycle. Sorry, I just lost my train of thought there. So that's a good bit of work by Julian. It actually, puts us into context. And the other thing I will highlight is if some of you are reading the Trade Tech publication or seeing it online, Trade Tech now produced what's called the Production Cost Indicator or Index. And basically what that is an approximate per pound basis is the weighted average full cost of extracting uranium out of the ground from emerging and returning projects before any profit. So basically what it is it's an all-of-industry break-even price for uranium production, not taking into account profit. Now, our break-even price is around $36.64, so if you plug that into our model, our NPV would be 0, so that's what we mean by that. So that does take into account capital and all costs at the project level, so it doesn't account for any head office costs or costs up in the Northern Territory, anything like that, of course. But again, very competitive and well inside Trade Tech's costs. One of the areas that Marcel touched on was the mining fleet. I have been asked about that in a few emails. When we did the DFS, we actually, it was sort of a hands-off approach. We went to 3 contractors and got contract mining rates And then based on those rates, we decided we would look at an owner-operate model. One of the reasons was the mining is very uncomplicated. It's not high risk. There's no drill and blast. And so we felt that we could manage the operations ourselves, with the appropriate people working for us. And that actually had a good cost savings on the C1 cost. And the reason for that is when a mining contractor comes in, they go buy a new fleet, and they look to recover some money on that as a profit center, and so that adds to the cost, and plus they have their margin. When we did the test pits, the Piacentini guys, who are a private company out of Bunbury, dominantly sand miners, they did a fantastic job on the pits. They were by far the cheapest contractor who bid for the job, and yet they still made a very healthy profit in their view. And so we invited them to come back in, and we said to them, let's put our heads together and try and figure out how we can reduce the capital without having a corresponding hit on the operating costs. And basically, we call it the hybrid owner-operate model. So we will buy some equipment. It'll be refurbished equipment. They're only one of, I think, 2 companies in Western Australia who can refurbish heavy earth-moving equipment. The other one's being Westtrac, so that gives you an idea of their capacity. And then we would need to buy new equipment, new used equipment during the life of the mine, but that would importantly come out of cash flow, and that is included in our sustaining capital costs in those presentations. Marcel, I might just get you to have a go through with the sensitivities, because surprisingly, the OPEX and CAPEX is relatively insensitive to some of the cost movements, and then maybe just have a chat about uranium price sensitivity, because we've taken a conservative approach by some measure on our price assumptions, and if the price does go higher, there's some pretty pleasing outcomes there. So maybe I'll throw it again to you, Marcel.
Thanks, Mike. The table I'm referring to is on page 4, and we examined variations of plus and minus 30%. Across what I'd call the major areas that sensitivities are usually prepared on, and that includes the foreign currency or the major foreign currency exchange, uranium price, OPEX and CAPEX. And it's very pleasing for us because what we see is a low to moderate impact at extreme levels, that is at plus or minus 30%. As Mike mentioned, OPEX and CAPEX is quite insensitive, and that is the black, excuse me, I've got a bit of a cold, and the blue line. And even for commodity price, it's quite unusual to see a commodity price which is 30% less than the base, which is $55. And I mention again that it was $60 back in January 2018, and we're at break even in terms of NPV. The major impact does, of course, come from foreign currency. And as you can see, if I can draw your attention out to the right, if the Australian dollar was to dramatically weaken back to, say, 46 cents, the project's NPV would jump to about 1.5 billion. Of course, there is a negative impact if it runs the other way. And so I think that overall this tells a great story about how strong and robust the economics are of the Mulga Rock project. Thanks, Mike.
Thanks, Marcel. I think with that we'll throw to questions. So we got quite a few questions, both in response to the invite to the conference, and a few came in by email. So we've kind of synthesized a lot of the questions into 5 questions that we'll go through. So I might throw to our host and open that up now.
Thank you, Mike and Marcel. I will now raise the questions that were submitted either via the registration process or by email. Your first question reads, I note that you're concentrating on the US market. Why not China? And why did you pick $55 for the study when some others have higher numbers like $60, including consensus forecasts?
Yeah, thanks for that. It's a good question. We have spent a lot of time in the DFS Refresh on the uranium market. Notably, we didn't repeat a lot of the information that's now out there on reactor builds and things like that. I wanted to concentrate more on our strategy. The U.S. market's about just under a third of the entire market. You would have seen, as a side note, overnight that Exelon is considering closing 4 gigawatt of power in Illinois as a result of asymmetric subsidies over there. That's a proposal. It's a bit of a shot across the bow, but even 4 gigawatts only half of our outcome, our output. So it's not a huge number. But the U.S. market's very important, and one of the reasons is that from a debt funding point of view, the U.S. utilities are low risk. They are low counterparty risk with strong balance sheets. China is certainly, the other country, of course, is France. So China, U.S., and France are the three big ones. The French basically only buy from producing miners, but I have a feeling, and certainly through discussions we've had with DFS, that if we start picking up U.S. contracts, they'll certainly look at us again. But at this point, the DFS, the EDF guys have said they'll come back to us more in production. In terms of China, China gets most of their uranium out of other Asian countries, notably Kazakhstan and Russia. They're not happy to pay more than the spot price in our discussions, but the Chinese have recently, as you would have seen through the purchase of getting into Husab, and then now partly into Paladin's operations, they're looking at doing what you call vertical integration. So they want to buy assets that are producing uranium and be involved in the whole supply chain. So with China, we do engage with China, but that's more of a strategic engagement. So we're looking at China as potential partners. We are looking at strategic partnerships for both Mulga Rock and Alligator River, and that's where I think China would come in. Why did we pick $55? Well, it's a bit of a how long's a piece of string. We didn't want to be overly bullish, but one thing we did do is spend a bit of time putting some very good sensitivities in there. So anyone who thinks the price is going to be 60 can plug that into the sensitivity and see that, of course, the NPV goes up. But we've done a lot of work. This is, of course, a contract price, not a spot price. And so we have what we refer to as the weighted average contract price. And so there's going to be a spectrum of contracts at different prices, different volumes, different terms, and different contract mechanisms. And what we are hoping and expecting is that the average of that will be around $55. Some of the early contracts may be a bit lower, and then, of course, as time goes on and utilities get a bit more desperate, it'll go up a bit. Just one thing that's worth noting is that the difference between $35, which is around where the price is now, and $55 is 0.125 cents a kilowatt hour to a utility, because they're creating 8 billion kilowatt hours a year of electricity, and really they don't use that much uranium, and so the price difference between those two isn't a lot. And when the utilities start to feel the pinch of security of supply, they will get into the market and the price becomes secondary. So I hope I've answered your questions there.
Thank you. Your next question reads, could you give us an update on the proposed funding arrangements? For example, debt equity ratio, prepayments, strategic investors.
I might throw to Marcel for that one. Marcel?
Okay. Thanks, Mike. Well, look, there's a number of open options that Vimy can and is considering to arrange project funding. However, it is likely that the majority of funds required will be sourced from debt, with the balance coming from our equity. And we are very open to various forms of debt, including loans that may be linked to offtake. As Mike mentioned, we've got major trading partners, including China and the US, who are also major users of uranium, and some strategic alliances may be possible, which would include funding with them. And of course, we'll look at other suitable global regions with our advisors. Lastly, we're also actively progressing this introduction of strategic partners and investors at the project level. And if we were able to get a partner or partners on board, well, I think we'll definitely be able to lessen the Vimy requirements to arrange the balance of those debt facilities. So we're really active in this area. Thank you.
Thank you. Your next question reads, are you concerned that Kazakhstan and Cameco could simply ramp up the future gap? What about fission and NextGen in Canada?
Yeah, good question. So in terms of Kazakhstan, if you'd asked me that question in 2017, I would have said yes, that's a risk, because the Kazakhs at that time were operating sort of Soviet-style economics, which is volume over value. But since that time, anybody watching this space would have seen that Kazakhstan has, not only have they listed on the London Stock Exchange, but they've matured corporately. They've got Westerners on their board, and they've become a company that is thinking now value over volume. Now, when you look at the Kazakh, and I'm referring to the chart on page 10 again, when you look at the Kazakh operations, each of those is a joint venture between Kazatomprom and another company. So Cameco is in there, you've got the French are in there, the Uranium One, various other companies. That company, the joint venture partner, can sell the uranium on contract at any price. However, Kazatomprom is obligated by law to sell their material at spot. Not in spot, but at market prices. And there's only one transparent market, and that's the spot market. So they don't want to see the spot price fall. They're making more money now. They are showing supply-side discipline. And furthermore, as you go off into the future, particularly later this decade and into the 30s, their production falls off. Their fields start to run out, and some people, it's my view, certainly, that I think we've seen peak Kazakh production. So I think you'll see a certain level of maturity from Kazatomprom now. Even though they are in joint ventures with these companies, the Kazakh government controls all of the subsurface licenses. You would have seen that they have committed in 21 to maintain that 20% reduction on the subsurface license. In terms of Cameco, again, even though their operations, Cigar Lake and McArthur River, are low operating costs, we've seen that they've seen online that they're not going to reopen McArthur unless they're getting contracts in the 4 in front of it or higher. So even though they're low-cost operations, there's a lot of capital gone into those operations, and for them to make healthy profits, they obviously want a much higher number. And the Kazakhs came out this morning saying that the price currently is not incentivizing new production. In terms of fission and next gen, well, those operations are still in the early phases. They are large. My view is that they will dovetail nicely in the last half of this decade and fill the production that will drop off when the Cigar Lake and McArthur River are exhausted. So there's a nice synergy for those operations. You've got to remember that those two operations, I don't think they've done DFSs yet. Marcel, is that you're doing the peer review? I think that's correct. And while they are big operations and they are cheaper operations, as I say, that they'll come in later part of the decade and fill a gap. So thank you for that question.
Thank you. Your next question reads, could you give us an update on where you are on approvals, including export permits?
Yeah, thanks for that. I just want to give you a high-level overview on how the approvals process works. So when we put our PER, Public Environmental Review, in, and it was approved in like 2016, that was an all-of-government approval, a ministerial approval for the operation. As we know, the Labor government in Western Australia doesn't support uranium. Well, half of them actually do. Anyone who knows Labor politics knows that Labor parties are quite divided in their views. It's quite a broad church, and most of the leadership group do support it. But what happened was, because we'd received those permits, those approvals from the state government, the Labor government came out very early in their tenure, and they said that the 4 operations that had received their state government approval were allowed to proceed, and one of those was us. Once that's done, you then go into what we call secondary approvals, and those are your environmental management plans, your work permits, your mining permits, project management plans, and all of those are done at the bureaucratic level. Now, our conditional environmental management plans are complete, and they are in with the government. I think we've announced through the quarterlies that 4 of them have been signed, and we've got 3 more to go. They form the basis for all the other approvals, the working approvals, things like that. So the best way to think about these things is if you go buy a block somewhere and you get permission from the council to buy a house. Once you've done that and you've submitted your plans and that's all been approved, you have to get a building permit, and that's the level we're dealing with. So Western Australia is very busy now in the mining space, and one thing we know is that, well, the approvals process is quite slow. We're certainly not alone. Julian Tapp, who is managing those approvals, works for us part-time. He's working on other commodities, including potash, which is, as we know, a very green mineral. And he's finding that the approvals process is just as slow for them as it is for us. So there's no fear of those approvals not coming through, and certainly the timeline for those approvals is well inside the timeline for moving to FID. And we'll have more announcements as those approvals progress. Export permits are done by the federal government. We have spoken to them about them. We don't need them right now because we're not exporting yet. They're basically a form-filling exercise. There's no ministerial approval involved at all. It's all done through the Australian non-proliferation and Safeguards Office, and those are just a fairly simple rudimentary document that you get every time you do a shipment out of Australia. So hopefully that's answered your question. So in terms of approvals, there's low to no risk on that side. Thanks.
Your final question for today reads, will you be doing a dual listing in the US?
I might throw that one to our corporate man, Marcel.
Thanks, Mike, and thanks, Ashley. Well, I'd really like to thank the interested party for putting this question, as Vimi's been receiving a lot of similar requests from potential investors in the US. I'm pleased to say that we're now exploring a secondary market listing. The one we're looking at is called OTC, or over-the-counter. It's one of a couple of ways to get into the US market. Look, it's definitely early days, but if we're able to proceed with board approval, I think we should be able to offer US investors the opportunity to acquire Vimy shares as early as first quarter next year. So that's where we're at with the dual listing.
Yeah, we certainly won't be. Yeah, we certainly won't be looking at a listing on the board and say the TSX or anything like that. This, as Marcel says, this is a way of giving retail investors in the U.S. access to Vimy. And there's certainly a lot of interest out of the U.S. We've got a group of New York City that help us with the investment relations in New York. And obviously, America gets 20% of their power from nuclear. It's over half of their clean energy. So there's a very strong awareness over there, and it might be worth noting that the Democrats, after 49 years, have decided that nuclear energy is certainly part of the answer to greenhouse gases. So it appears that the woke party is awakening to nuclear. So that's a good sign as well. So positive signs of America, notwithstanding the excellent announcement. And certainly, there's a very strong interest in uranium equities in America. So that's one of the options we're considering, and I think it's we'll have more news on that as we progress it. So thanks very much.
Thank you. That does conclude our conference for today. Thank you for participating. You may now disconnect.